because apparently 2 students just couldn't come today, and so at least they can access what we cover in class on the Moodle page. All right, cool. All right, so although 60 million of goods were sold during the year, only 50 million cash was paid to the supplier for those goods. Okay, and so the journal entry, if we were to record this, all right, we'd have, we debited cost of goods sold, we had cash paid, all right. We saw the change in inventory. Okay, inventory went down, so that's why we're crediting inventory. Okay, accounts payable went up. And so, again, we're crediting to make an accounts payable go up, we've got to credit that. And so you can see if we were to plug the cash here, okay, we'd end up with the 50 that were shown in the T accounts. And so again, I hope what this allows you to see, all right, is the impact on cash for each line item on the income statement. So depreciation expense, all right, it does not require a current cash expenditure, right? Because again, it's a systematic and rational using up of a fixed asset, which we paid for a long time ago, all right? And so again, my advice is not, all right, to look at the accumulated depreciation, right? What I would recommend is looking at the depreciation expense. Again, we're able to pick that up right off of the income statement. Right? However, we're not going to make any journal entry, right? Or we're not going to make any adjustment because this is a non-cash expense. Therefore, on the direct method, we just completely ignore it. That is not the case when we do the indirect method, if you remember, and we're going to look at that briefly. Okay. Interest expense, right? Bond interest expense is not the same, okay, as the amounts of cash paid to bondholders, right, when bonds are issued. And the reason being, right, are for premiums and discounts. Because if you remember, discounts increase, right, interest expense, and premiums decrease interest expense. And so, right, if we have what was recorded, all right, again, on the income statement, we had interest expense of $5 million. Okay. However, we amortized, right, that discount. We spread that out. Okay. Take note, right, by crediting this and crediting the cash that we pay, this increases the amortization of a bond discount, increases our interest expense. And so really, right, we could actually find out that our bond, all right, the cash that we pay, remember the cash payment equals the face times the stated rate times time. Whereas interest expense, right, is the face times the market rate times time. And this is really the difference between the cash payment, the annuity, right, and then the interest expense. I guess I should say this is the carrying value, not the face amount. So, all right, if we had a beginning balance, all right, of insurance, or we're looking at as a prepaid insurance, was an asset, all right. So we have the change of that asset on the balance sheet. Okay, we had the beginning balance and the ending balance, right? So we had a $3 million change, right? However, because of the increase in insurance expense, right, we would have seen this on the income statement. We can then plug, all right, that we must have paid an additional $4 million, all right, to purchase additional insurance, or the journal entry that looks like this. And again, all we're doing is we're using journal entries, and hopefully you're understanding, right, of debits and credits, right, to derive a different calculation. If I can, all right, we know, okay, that we had insurance. I don't know what that is. Right, insurance expense. Okay, we had that on the income statement was 7. Okay. This is under accrual basis of accounting, right? Because insurance expense is a debit. I'm just trying to bring you back to how I taught you. Okay. Assets, liabilities. Okay. And in this case, because we're adjusting an expense and not a revenue or a credit, right? It's just going to be the opposite of the normal one, right? And so this is going to be plus, minus, minus, and plus, okay? And so, all right, if we had an increase, or in this case, this is an asset, right, prepaid insurance, and it went down, okay, so asset went down, we're going to subtract. Right? What are we going to subtract? Right? We're going to subtract that difference. Right? That was a $3 difference. So we're going to subtract $3, and that comes out to be 4. We adjusted this, all right, from accrual basis of accounting into cash basis. And so it's showing you the same information, right? Just 2 different ways to get to the same number. And so hopefully one of those ways resonates with you, and you'll be able to apply that on the exam. Income tax expense, again, what we'd be looking for, the corresponding balance sheet account, which would be income tax payable, all right? And that's what we're doing here. We had a beginning balance of income tax payable of 8 million, right? We had an ending balance of 6 million, right? So again, this is an expense, and we could see, or we could calculate this the same way, all right? We had income tax expense. That was 9. We picked that right off the income statement. Okay. We had a decrease, right, in a liability. Okay. So if we go back here, and we had a liability, we decreased it. We're going to add that, aren't we? So we had a decrease in the liability of 2. We're going to add 2. We come up with the 11. And so balance sheet accounts, right, must account for the changes in each account on the balance sheet, right, and their corresponding transaction on the income statement. Short-term investments, all right, the entry to record the investment and our summary, all right, is as follows. We had an increase in our short-term investments because we don't have any corresponding payable. We must make the assumption that we paid that in cash. Again, this investment is going to be recorded in the investing section of the cash flow statement. Land, right? And take note, in this scenario, I think we had a purchase of a land, and then we had a sale of a land, whatever. You are going to need to have some detailed information. So a $30 million purchase of land for the portion of the 20 million increase, all right? So in the previous example, we sold $10 million worth of land, right? That was, I think we had the gain on that one, didn't we? Okay. And so just by looking at the change in land on the balance sheet, we had a 20 million increase. However, that consisted of 2 different transactions, right? We purchased 30 million and we sold 10 million. So again, as long as there's not a corresponding note related to the purchase of that land, we would have make the assumption that it was cash paid for the land. And again, this would be under the investing activities. Buildings and equipment also deal with, or are also reported under the investing section, all right? And so investing in new equipment is a significant investing activity, and the financing, the acquisition with long-term debt is a significant financing activity. And so in this case, we purchased some equipment using long-term debt, right? The journal entry for this, right, would be given as such, but $20 million, okay, we got to explain that, don't we? All right, because no cash changed hands for the purchase of this building. And so this we're going to put in a separate schedule. This is a significant non-cash transaction. We need to disclose that information. Non-cash entry above, all right, would not affect the cash flow, all right, because there was no cash that flew or flowed. But yet we need to disclose this information because anybody looking at this will say, hey, wait, all right, why did we have an increase in buildings but not a corresponding decrease in the cash? Well, the reason being is we didn't use cash to buy it. Bonds payable, the spread sheet entry duplicates the journal entry. Okay, so we had a decrease in our bonds payable, all right, and we paid that off, all right, with our cash. And again, this is going to be recorded in your financing activities. I want to speak to this because, there is a possibility, right, that, we refinance these bonds payable with another issue of bond. You'd probably need to disclose that in the notes to your financial statements. Common stock, right? To record the small stock dividend, we capitalize retained earnings, right? So this would be the journal entry that we made. As you can see, no cash is impacted, right? Stock dividends do not represent a significant investing or a financing activity, so this transaction is not reported in the statement of cash flow, right? This, right? Again, no cash changes hands. Retained earnings went down, right, and paid in capital went up, and so no cash changed hands. And you might want to put some note disclosure there, right, as far as significant non-cash transaction, because 13 million is, I would say, significant. The sale of 2 million shares of common stock at $13. Or again, what we're looking for is we're looking for this number, right? Cash received from the sale of stock, right? Again, it's going to be financing activities. And really, all we need to do is see the difference between the beginning and the ending common stock. However, we have to also account for the stock dividend that we just got done dealing with, right? And that's what these two are. To be able to recalculate or to come up with the cash received. Now, again, if you are actually the one that's responsible for building this cash flow statement, you have access to all your ledger accounts, right? And so this detailed information is available to you. And you probably were the one that made the journal entry to begin with, all right? And so retained earnings, okay, the change in retained earnings, okay, consists of the stock dividend, the increase from net income, okay, cash dividends, all right? Okay, yeah, so, the cash dividends, and again, we wouldn't necessarily just need to make a T account, right? We could actually go back to the journal, right, and see the cash disbursements journal, the cash dividends that were paid. So completing the spreadsheet, all right, compare the change in the balance of cash account with the net change in cash flows produced by the activities listed in the statement of cash flows section of the spreadsheet. Confirm that the total debits is equal to the total credits, all right, in the change of the spreadsheet. Right. Paige is joining us, so hang on a second. To complete the spreadsheet, we include the final summary, right? Cash, all right, net increase in cash, all right, from the statement of cash flow activities. And so if you remember the reconciliation, right, because what we're trying to do is we're trying to reconcile the change, all right, from 1 year's cash to the next. If you remember from the balance sheet, there was, I think it was a 29 or 20 to 29 or something like that. We had an increase in cash of $9 million. And so that's our check figure. And so here's an example of CVS, all right, their cash flow statements for 3 years shown. And again, we know right out of the gate that this is the direct method, right, because it doesn't show us net income. Right? It just says cash receipts from their customers. Right? So again, we took sales under accrual basis, and we increased or decreased it based on the change in accounts receivable. Right? Cash paid for inventory. All right. Again, all we did was we took cost of goods sold, we adjusted it for the change in inventory, and we adjusted it for the change in accounts payable. Right. And so we walked through, all right, all these different transactions. So cash flow from operating, investing, and financing. So there's your three activities. Then you have your reconciliation down here, right? So we're trying to reconcile where did this cash come from, right? Well, it came from those three different areas. We add that to the beginning balance of cash, and that gives us the ending balance of cash. And so again, as I presented, that's where I start. I say, hey, how can we explain, right, the decrease of $14 million in 2011? Well, we had cash flow from financing activities, all right? That was a huge outflow. We had an inflow, all right, from operating activities, and we had an additional outflow, right, from investing. So this, subtract this, gives us the $14 million decrease. Then, all right, in the notes to the financial statements, all right, if you remember, if we choose to do the direct method, right, we have to do a reconciliation to net income, right, and disclose that information in the notes to the financial statements, all right. And so here, what we're doing, okay, is we're taking net income, right, and we're adjusting it, right, for changes, okay, that impact your operation. And wow, doesn't that look very similar to the indirect method? And the answer is, it is. It's identical. And so, again, if you have to do the cash flow statement, why do it twice, okay, when you have the option to do the indirect method? And a lot of people think that way. And so a lot of people just do the indirect method, and they do not do the direct method. However, direct method is a better way of communication. So the indirect method, net cash increase or decrease from operating activities, which is the only section that is different, right? Hopefully you remember that it's only the cash flow from operating activities that is different. And so what we're going to do, all right, we're going to start with our reported net income. We're going to pull that right off the income statement, okay? And then, they suggest you work backwards to convert, to the cash basis. You can, right? You can use that worksheet or all those transactions. Right? However, in this case, my preferred methodology, right, is just to use our cash flow table, right? And so this is the initial one, right, where we have increases and decreases. This would be represented outflow, inflow, and outflow. But, I mean, again, they're going to use the tables. So we start with net income. My advice, truthfully, all right, two things that you want to do right away is you want to adjust this, right? First of all, the way I do mine is I add and I subtract. Okay. And the first thing I'm going to add is my depreciation expense. You would also add back maybe any amortization, depletion, right? Any non-cash expenses. Okay. We're going to also add back any losses, and we're going to subtract any gains. We're doing these losses and gains not because they're non-cash. It's because they we're going to account for those either in investing activities or we're going to deal with them in financing activities. But that's just the way that I set mine up, right? And again, my methodology, all right, is to utilize forms, all right? And so, you know, if you can set up a format in your mind, right, and follow the steps, you can just drop the components in as you go. And these are 3 components that I would start with so that you don't forget those. We adjust it, all right, for non-cash effects, gain on sale of land, depreciation expense, loss on equipment, and then the changes, right? And so again, we can look at the income statement and say, oh, we had an increase in the accounts receivable. Increases, right, result in a cash outflow. Right? We had a decrease in inventory, all right? So inventory is an asset, inventory going down, we're going to add that. And do line by line, all right? And these are all the current assets, right, and liabilities. Right? And if you remember, I really don't, okay, but you know, this 22, all right, this net cash flows from operating activities would be the same whether you're doing the indirect method or the direct method that we previously done. And so components of net income that do not increase or decrease cash, right? Amounts that are subtracted in determining net income are added to reverse the effect of their having been, right? You know, so again, these are really adjusting entries, you know, because of the matching concept. Because, you know, the income statement is recorded based on accrual-based accounting when the cash flow statement is the cash-based. And then just the opposite, all right, amounts are added in determining net income are subtracted to reverse the effect of them having been added. What a beautiful diagram. Components of net income that do not increase or decrease cash, all right? But by the amount different from reported on the income statement, net income is adjusted for changes in balance of related balance sheet accounts. You convert them, you know, as I said, into the cash basis. The sales of 100 million are included in the income statement, right? However, you know, that consisted of, you know, well, not really. Okay, I don't want to say that it consisted of $98 million in cash, right? But we collected the 98 million, okay, this year because most sales are on account. It's just if something is net 30, okay, within a 1 year time period, you know, the bulk of those are going to be collected, right? It really is only representative by a $2 million increase in our accounts receivable. Again, we'd subtract that, bringing it down to the cash that we received, 98. So here's a comparison, all right, as far as presentation. Right? And so we had our income statement, okay. Under the direct method, we converted line by line, okay, cash received from customers, right, from the sales, cash received from investments, right, those are the interest, right. You know, whereas this, okay, the direct method is really easy to understand. This is cash received, this is cash you received, this is the cash you paid, this is the cash you paid, and so on and so on and so on. Okay? Whereas over here, this is really confusing, you know. So we have net income, and we subtracted the increase in accounts receivable, and then we took this gain out of here, and somewhere in here we took out our depreciation expense right here, and you know, that really doesn't make any sense, all right, to somebody that does not have an accounting background. Right? But one of the benefits, right, is that we can tie this, okay, to here, right? Because we've already done the income statement, we've already done the retained earnings statement, we've already done the balance sheet, okay? And so what this does is it ties the cash flow statement, right, to the income statement up there, okay? And then it doesn't show it on this one, but also then it ties it back to the balance sheet, right, by the net change in cash. So adjustments to convert net income to the cash basis, the indirect method, right? It's basically looking at all the components, right, that I've already highlighted. All of this, right, can be, communicated in this little table. Okay. I should say not these ones. All right. So the non-cash depreciation things, and then also gains and losses. Okay. But all of this is summarized in this little table. So the advantage of the direct method, all right, the FASB, all right, strongly encourages companies. Why? Because it is better communication. Investors and creditors gain insight into the specific sources of cash receipts and cash payments. Okay. The statement users can be more readily understand the information that's being presented. Nonetheless, the vast majority of companies use the indirect method. Why? Because this is the way it was done, for a very long time, right? And I would also say because it ties all the financial statements together. So the reconciliation of net income to cash flow from operating activities, right? They're just looking at, financial statements must report the reconciliation of net income, right, to operating. And so if you use the direct method, you in essence are doing it twice, okay? Where under the indirect method, you're just doing it once. The choice of method used to derive net cash flow from operating activities does not affect the way cash flows from investing and financing activities are identified and reported, right? And if you were in my class, Accounting 202, when we cover this chapter, I basically say, hey, do the indirect method from start to finish, all 4 sections, 3 activities in the reconciliation, and then just copy, right, the reconciliation and the cash flows from investing and financing activities from the first problem, all right, when you do your second problem, because the only thing that is different is the operating activities. So from a decision maker's perspective, cash flow ratios, right? Cash flow ratios are derived by simply substituting cash flow from operating activities, all right, in place of the net income, all right? So you're just swapping cash flows from operating activities. Right? And so the times interest earned ratio can be modified to reflect the number of times the cash outflows for interest provided by the cash inflows from operations, and any of the profitability ratios can also be modified. And so here's some examples. Right? And so cash flow to sales, so if it would have been net income to sales, right? Return on, assets, right? We're just looking how, we substitute, cash flows from operating activities from net income. Sufficiency ratios, again, we're just, wherever it was net income, right, we're substituting it for cash flow. And that's the end. That is the end of intermediate accounting, all right? And so let me turn on my camera so I can applaud you guys, right? Because I am really proud of you guys as a class, all right? Especially this semester where it's been really difficult, and I know a huge change to our lifestyles. you guys not only dealt with the change graciously, right, for me, in school, I hope, but also you guys thrived, right? You guys did so much better on your third exam than you have on your first two exams as a whole, as a class. And I'm really proud of you guys. So good job. So, I really don't have anything left for as far as lecture. Right? So if you guys have any questions, I really want to open it up to you guys asking. Again, the final exam is a week from Thursday, right? We do not have class on Tuesday of next week. That's your exam prep day. Thursday, we will do a review of the final exam and hopefully answer any questions that you have from the homework. I'm pretty sure I didn't post a quiz for chapter 21. I don't intend to either. So just make sure you do the homework, and you should have a really good grasp of your grade going into the final. I think, well, no, none of you.
What homework we do Thursday?
Pardon?
Yeah.
We're gonna do the homework Thursday. Do Thursday.
Yeah, the homework I believe is due on Thursday, so you'll have time then.
Okay, because it was showing for me that it wasn't open until the 30th and then closed on the 1st.
All right, I will go fix that. All right, so
Yeah, that's what I want.
Okay, thank you.
all right, so yeah, I'll make it do. Yeah. Okay, so connect. Funny thing is, man, yesterday I was having a lot of computer issues. My finance class, which is my Ferris class I teach for Ferris, they were supposed to have an exam that I was trying to post to another Moodle site, and it was just dogging. And so I actually told them, was like, hey, I want you guys don't take it today because the system is running so slow. But then I went to sign in to one of these homework packages that I've had the autofill for 20 years. And I haven't been working there 20 years, but for a super long time, and it didn't remember my password, and so I was trying to draw on all my ability to come up with what my old passwords were. I was able to figure it out, so I was happy. So let me see, built-in problems.
Yeah, Engage did that same thing to me earlier.
Let's see, edit that. Yeah, May 1st. Yeah, we're going to be gone by then, aren't we? So let's put that on the 23rd. All right, so that should be fixed as is. Yeah, there is a practice quiz in there for you guys, so yeah, I'm not going to build another quiz. Yeah, it's funny because I want to look at you guys this way, but the camera's on this screen. So. Is there anything else? All righty. Well, we'll call it a day then. Look forward to seeing you guys, hopefully, well, I mean, online, of course, but hopefully in the fall at Ferris. So, cool. All righty. Well, unless you guys have anything else, I'm done.
Thanks, Chip.
Thanks, Chip.
Yeah, thanks.
Aloha.